Well, I would imagine while China is basically closed down, there won't be any trading there. You're going to see COMEX pull some tricks. It would not surprise me to see whether it be 1, 2 days, 3 days. It would not surprise me to see a pretty big hit on gold and silver because you don't have the Chinese there to buy in the physical markets to stop COMEX from selling the unbacked paper contract. That's going to be a problem for them though, because when you sell something you can't deliver on and there's a delivery, I mean, we are in the middle of a delivery month for COMEX silver. What's going to happen at the end of the month? So they smashed silver this week. And I mean, that's just a guess of mine. But if they smash silver this week and then China comes back next week and we go into the first notice day on the 27th, that's going to be a big, big problem for COMEX. I mean, their days of pulling rabbits out of the hat are pretty much over. I mean, obviously, the volatility from $123 has been downward to this, call it 65 to 85 range. I mean, even if we did not have a major delivery month for March, first notice date of February 27th. Even if we did not have that as a potential catalyst to actually smoke the market, to see silver just go sideways for a month, 2 months, 3 months, I mean, that would not be a bad thing at all because the overbought has already been worked off. But you'd work the overbought completely off and basically set up a new base for another run. And I think that Michael Oliver is absolutely correct, is that you're going to see triple digit silver, possibly $200 or $300 silver by the middle of this year, based on the fact that there's a well-known supply and demand deficit, and it's almost 500 million ounces. Go ahead. I was just going to say the world has woken up to the fact that you can't use COMEX contracts for silver applications. You can't print silver, and that's the problem. In COMEX gold and silver, there's 4 out of the 12 months are primary delivery month. We had January and also this month, February, we've had double, triple, quadruple the amount of deliveries normally made in a non-delivery month. March it's a primary delivery month. The first notice day is the 27th. First notice day is when contract holders alert the exchange that they're going to stand for deliver. They're going to hold it through the month and they want to be delivered on their contract. So it's going to be interesting to see how many are standing the first day. There's only 103 million ounces supposedly unencumbered in the registered category for delivery. So looking at 103 million, there's, I forget the number, it's over 400 million ounces are outstanding by contracts that are in existence today. So even if only a quarter of those stand for delivery, that's going to speak for all of the COMEX inventory that they have. Now, what happens if 200 million stand or 300 million stand? If that were to happen and the silver does not exist or doesn't just magically show up to deliver, then they will have to force majeure. There's an argument, is force majeure a failure to deliver? Contractually, I guess no, it's not, because it is in the contract that they can force majeure. They can claim force majeure, which means something out of their control caused them not to be able to make delivery. Well, you can argue whether it's out of their control or in their control. The bottom line is people who bought COMEX contracts, if they're told, here, you got to take cash, you can't have silver, that basically shows that the COMEX silver market is a fraud. So it's going to be interesting to see what happens. How much is standing February 27th? Because that number is only going to grow throughout the month. And we've seen this for the last 2+ years now. It used to be if there was, and I'll just use the number of 100. If there was 100 contracts standing at the beginning of the month, by the end of the month, there might only be 5 or 10 contracts left standing. But for the last 2 years, pretty much every single month, there's more at the end of the month than at the beginning of the month. So that's new. That's within the last 2 years. And like I said, what happens if we have 100 million standing the first day and there's 100 million in inventory? People are going to look at that and say, hey, I got to get in line now. It'll be like blood in the water with a bunch of sharks. Well, first off, understand that there was a psyop, if you will, going back to 1971. 1971, when Nixon closed the gold window. There's been a psyop in the West, gold bad, dollar good. When I say dollar, I'm including, other Western fiat currency. So there's been a concerted effort to steer people away from the safety exit, steer people away from gold and silver. I mean, you go back 25 years ago, you had central banks in the late 90s selling gold, and the headlines, people were always looking for headlines, which central bank is selling. And it culminated with Brown. They call it the Brown bottom in 1999 when Britain sold, I think the number was what, 60% of their gold reserves at some stupid number like $286 an ounce. And that turned out to be the bottom. But there's been a concerted psychological operation on the Western population. That's one thing. Another thing is the West has been wealthy for a long time. And you've seen a lot of selling, particularly in North America. You've seen a lot of Americans selling over the last 6 to 12 months. And the reason being, the cash flow is faltering. So people are getting squeezed. So what do? They sell what they can to continue their lifestyle, to continue life. So the West, the cash flow is failing, and you have people used to a higher standard of living, as opposed to the East. That's still a growing economic area. And you've got more and more people becoming middle class, upper middle class, wealthy, etc. And as they earn, they're thinking, well, where do I save? And it's pretty clear. All you have to do is look at fiat currencies since the last 20, 25 years, and they fully understand you don't save in fiat, you save in something real. And there's your demand for gold and silver. For gold primarily. Silver, the demand obviously is coming from all over the place. Coming from the green deals, coming from industry, coming from the medical field, you name it. Silver's used. Militarily, technologically, I mean, silver's used everywhere. A COMEX default will lead to credit grinding to a halt. Credit grinding to a halt destroys the real economy. It completely blows up the financial markets, and when financial markets blow up, you're going to have some losers. I mean, derivatives are it's a closed game. There's only a winner and a loser. And if the loser loses so big that they can't pay, then the winner becomes a loser because they didn't get paid. And what happens is the losers they go into bankruptcy, they default, basically, and then you have what David Rogers Webb talked about. You have the great take. You have brokers that in order to save themselves, they have to take client funds, which is now legal. That's not, I mean, you can sue all you want, but you'll get thrown out of court because the laws read that your bank, your broker, your insurance company, your financial institution is the legal owner of what you think are your assets. They're your assets in name only. In other words, it's for the benefit of you, but the institution is the legal owner. So your institution gets into a problem, they're going to take your funds. The great taking is 100% real, and I believe it's 100% going to happen. So you've got to get out of the system. You've got to get your capital out of the system. If you think I'm crazy, only take 10% or 20% of your capital out of the system. At least you'll have something. They can't print gold, they can't print silver, they can't print wheat, they can't print real assets. They can only print more contracts. And this is it's a problem of their own making over many, many years. And when I say their own making, I mean, let's go back, 2 weeks ago when silver took the $35 drop in one day. You didn't hear a peep out of COMEX other than, and we're going to raise your margin rates. That's the only thing you heard out of COMEX. What did you hear out of China? They shut down 6 entities. There was like 249 traders that were reprimanded. That when I say shut down the 6 entities, they're precluded from trading for the next 30 days. So they took some very real step against egregious naked short selling. Here in the United States, the CFTC, you didn't hear a word.